I like to put it this way for investors. So if you're owning BND, you're getting that, 5.8 years duration, a 4.8% yield. You can kind of do some analysis to understand what would a rate move actually mean for that portfolio.
All right, joining me will be Rebecca Venter, Senior Fixed Income Client Portfolio Manager at Vanguard, who currently offers 116 ETFs, over $4.5 trillion in assets. They're, of course, one of the top 2 ETF issuers in the country. And Rebecca, as we will get into, she serves in a unique role where she obviously has to stay on top of everything going on in the fixed income markets, but she also has to fully understand the thinking and positioning of Vanguard's bond fund managers. She also has to know Vanguard's fixed income offerings inside and out. And she has to communicate all of this to clients. And lucky for us, she's going to share some of her insights this week. We are going to talk about how Vanguard is currently viewing the fixed income markets. We'll also talk about what Rebecca is seeing in terms of how Vanguard clients are positioning within fixed income. Let's see, we'll touch on some Vanguard ETFs and broader industry trends. This should be an excellent conversation on a topic in fixed income that I know I'm a broken record here, but I truly believe this continues to be a significant challenge for a lot of investors and advisors. So she will join me here momentarily. Now, later, I'll be joined by Jon Maier, Chief ETF Strategist at JP Morgan Asset Management, who's also a top 10 ETF issuer, actually now up to number 6. They have 78 ETFs with nearly $340 billion in assets. And Jon is a longtime industry veteran who, as part of his role, he leads JP Morgan's ETF Insights, which is a global program designed to provide thought leadership and resources around ETFs. That includes the firm's quarterly guide to ETFs, which, if you're not familiar with that, you should be. And so he's going to tell us more about that guide and some of the big industry trends he's tracking right now. And then Jon also recently published a mid-year ETF outlook. And in that, he highlighted 3 key themes that are impacting how investors and advisors are allocating assets right now and how that's ultimately impacting ETFs. So we'll get into that as well. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now first welcome in Vanguard's Rebecca Venter, who is joining me from Malvern, Pennsylvania. Rebecca, it is an absolute pleasure. Welcome to the podcast.
Thanks so much for having me, Nate.
All right, so before we get into our conversation on everything fixed income and fixed income ETFs, tell us a little bit more about your role at Vanguard. Did I describe that pretty well at the top? Anything you would add to that?
You described it really, really well. I just summarize it by saying, as a client PM, I kind of serve as the connective tissue between our investment teams that are actually on the desk trading the securities that go into our mutual funds and ETFs. I serve sort of as a proxy for those individuals while they're doing their role managing the funds. And then I bring those insights and make them actionable for our clients. So the users of Vanguard bond funds and ETFs, which range from individual clients to financial advisors, folks using our products in their retirement plans. So it's a pretty fun job of getting to connect all of those dots day to day.
Well, that's perfect. And now you're going to serve as the connective tissue with the ETF Prime audience in bringing Vanguard's fixed income ETF insights here. So look, a lot we're going to cover. And if you don't mind, I actually want to start with my own observation and get your reaction to that. And then I think we'll be off and running from there. And so if I were to lay this out anecdotally, Rebecca, my sense is that a lot of investors and advisors are very hesitant to take on any meaningful duration risk right now because they're obviously worried about inflation and what the Fed will do and rates ticking up. And I mentioned how fixed income is such a challenge right now. I think a lot of investors and advisors, because of that challenge, what they're doing is they're simply throwing up their hands and they're just parking in shorter term vehicles, right? They're content to scoop up 3.5%, 4% and just call it a day. They don't feel like they're being compensated for any additional duration risk. And actually, as I know you're keenly aware, we see this in the flows, right? If you look at ultra short duration fixed income ETFs as an example, those continue to vacuum up money. And so to start, are you hearing the same thing in conversations that you're having? And as you look at how Vanguard clients are positioned?
Yes, definitely. This trend of staying on the very front end is one that was really strong last year and has continued this year. And so we hear it come up all the time in our conversations with advisors in particular. It feels a little bit like folks see the attractive rates on the front end of the curve and they're waiting a little bit for the perfect moment to get back into duration. We talk about this all the time. It's kind of been the case since the rate hiking cycle of 2022, this idea of cash on the sidelines. But we've been thinking about it a little bit differently, actually, to throw a little bit of a wrench into it. We think that's a little bit of a misnomer, potentially, the cash on the sidelines theme. So while we're seeing more interest in ultra short this year, if we actually zoom out and look at the percent of financial wealth of households overall, a lot of it's in cash, but it's actually below peaks. And so when we look at this at Vanguard, we see this in our individual investors' portfolios as well. We do think they're favoring cash over bonds in many ways, but it's actually more of it's a longer term trend as well. So we think there's a big opportunity to educate folks on the benefits of taking some steps out the curve into fixed income from very, very short term positions.
Well, in terms of doing that, maybe a good way to further frame this conversation is to look at an ETF like BND, the Vanguard Total Bond Market ETF, which is obviously an excellent proxy for the broader bond market. And if I look at that right now, it currently has a duration of just under 6 and a 30-day SEC yield of around 4.6%, a little bit above that.
Yeah.
How do you frame the potential benefits of that risk return profile? Because to your point, if people are going to move from these shorter duration products into, let's just say, something like BND, how do you frame the reason for doing that?
Well, I think it's a better case to make today than the last couple of years, of course, because you've had a normalization of the curve. So if you're an investor that's sitting in the very front end, let's say you're in a 3-month T-bill type of product, which might be more comparable to true cash, you're already missing out on more than a full percentage point in yield if you're trading that off instead of owning BND. But the risk that we think these investors maybe don't think about as much is just the opportunity cost, because you may get stability in cash. You certainly will get that, but you will not get that counterbalance to equities in your portfolio if we were to enter a down market in equities and more of a downturn in the economy, which those things are very hard to predict. That's what we've seen over time. So we like to think about it as maybe the risks that investors aren't thinking about. And you can also put it a little bit of a different way. So we are hearing a lot today, just questions around the Fed. Everyone knows inflation is still a challenge, and we're all kind of wondering what actually happens to the policy rate. And so when we look at what the market is pricing in, we see that the market has been kind of pricing in, a hike and a half to 2 hikes. So about 50 basis points of a policy increase priced into the market. In our view, if you were to actually see the Fed re-engage in tightening policy, you'd likely only see, maybe 3 hikes, so 75 basis points, maybe a full percentage point. So about half of that risk is already priced into markets. So we think that, we understand why investors have this fear and are wondering about the risk of owning duration, but we think that they're getting pretty well compensated for that, and certainly will be compensated in the form of ballast to equities if we do enter one of those unpredictable down markets.
Yeah, I love your point just regarding a portfolio ballast or counterbalance, because you're right in that if your portfolio doesn't have enough duration, then it isn't going to be able to provide that ballast or counterbalance if we do get into a situation where we have a meaningful downturn in equities, the economy weakens, et cetera. And I guess the good news is we know at least some investors are paying attention here, because I was looking this morning and BND has taken in nearly $19 billion in new money this year. It's in the top 10 of all ETF inflows in 2026. So some people are getting that message. If we put aside the conversation around duration risk, and maybe we can come back to that in a moment. I know Vanguard has some brand new research around how the firm's millions of investors are positioned right now. And you were alluding to this a little bit, but my understanding is you're seeing a lot of investors and advisors just underweight fixed income in general, right? They're holding more stocks and some cash and other
Yep.
assets. I would say especially younger investors, which I think makes sense that you would expect younger investors to hold more in equities, but it sounds
Yeah.
like there may even be some sort of an underweight here. So what exactly are you seeing with that?
It's just like you said, Nate. It's relative to if you expect the average investor to own a 60-40 portfolio or something close to that, we are seeing a bit of an underweight to fixed income. And we think that it almost looks like a lot of investors are thinking of cash or owning more cash where they historically may have owned more fixed income. And it certainly does get worse the younger the clients are. But as you said, we wouldn't expect younger clients to own a very large percent of their portfolio in bonds. That starts to really pick up its relevance in your portfolio construction as you get into the later years of your investment horizon. So that is what we're seeing across our investor portfolios. One factor there may be that a lot of this cash is held actually in the settlement funds that investors hold here at Vanguard, which is automatically invested into a money market fund. And so, of course, as we've seen over the last several years, you're earning a pretty attractive yield just in that position. And so that may have with the volatility in markets, it kind of creates even more inertia for investors to actually want to move out the curve and take advantage of the benefits of fixed income. So we see that as an opportunity to just re-educate investors, kind of talk more about the prospect of really growing wealth in fixed income. Because as we look at it today, as we started talking about, you're earning almost a 5% yield on a very high quality defensive asset class that is really going to serve a role with your equities in your portfolio.
If we come back to duration risk or rate risk, just because I can't help myself, I'll
Yeah.
tell you, I hear a lot of investors and advisors, and to be honest, I've been guilty of this as well, by the way, of pointing back to 2022 when we saw both stocks and bonds falling at the same time. And obviously, Rebecca, that was an historically bad year for bonds. That was clearly an outlier. However, I do think that certainly got the attention of investors who they thought bonds were a diversifier. And my question for you is, do you think the scars from that year are still factoring in to how investors approach fixed income in the year 2026?
It seems to be the case, at least for many investors. And it kind of gets back to that idea of waiting for the right moment, this expectation that at any point rates could sell off meaningfully and create another one of those experiences. In our view, that was, as you said, more of an anomaly of a year. And I like to put it this way for investors. So if you're owning BND, you're getting that, 5.8 years duration, a 4.8% yield. You can kind of do some analysis to understand what would a rate move actually mean for that portfolio. We talked a little bit about the Fed and what the market is pricing in. Let's say the market moved to price in 50 more basis points of rate hikes, and that occurred across the curve. You would still, over the next 12 months, if that happened all at once, you would still have more than a 2% positive return holding the ag. But let's look at the flip side of that as we talk about the ballast properties of bonds. If, let's say, it becomes clear the Fed is not going to hike rates, you see 50 basis points of cuts or hikes get priced out of the market, well, then you're sitting with a potential return of about 7.5% over 12 months by owning the ag. So you can see there the really powerful, nearly 5% income return you're getting, as well as the potential for bonds to provide that price appreciation. So it's a much different starting point for investors than 2022. So we think that we're maybe going to be fighting that battle for a couple of more years, but there's certainly greater awareness around the total return you can generate in fixed income today. And one thing you can look at just to prove that point out is spreads across credit sectors of the market are remarkably tight. Investors are taking note, as you called out the inflows into B&D this year. There is steady demand for the asset class, but clearly as we look at this heavy position in cash, there could be definitely more demand coming as investors take note of these benefits they could have by owning bonds in their portfolio.
Yeah, a lot of excellent points there. It's interesting to me because, as you know, following 2022, we saw all these headlines about the death of, say, the 60-40 portfolio, particularly focused on the 40 side. And you've seen a lot of alternative asset managers come in and say, you should look at alts because bonds aren't going to be the portfolio ballast or diversifier that you want them to be. And, perhaps we're always going to see that from time to time if there's a down year in bonds. You mentioned spreads. We've been focusing more on the duration side. Let's talk about the credit side of the equation. And I guess I'll just ask you any strong views around how investors should be thinking about credit risk at the moment, because credit spreads are at historic lows.
Yeah, I think, and when we look at that, we think it's pretty just understandable that credit spreads are at low levels, because if we look at the underlying fundamentals for the companies that make up, let's say, the corporate index, we have a team of more than 50 researchers looking at these markets and trying to understand what's the credit risk involved in each individual company. And when they aggregate that information up, they see a market that is really, really healthy, whether you're looking at earnings growth, you're looking at the balance sheets of these companies, management that's running these portfolios very conservatively. There's upgrades. The sector just looks very healthy and high quality to us from a fundamental standpoint. And so given that, as well as just attractive yields that are bringing in a lot of demand, we think the fact that spreads have stayed at these tight levels, despite some ongoing pockets of uncertainty, headline risk, we think it largely makes sense. And we are also, if you take the broader picture, our view is that the economy is likely to carry on pretty strong this year and next. So if you put those factors together, we think investors should feel pretty comfortable earning that extra yield in credit and taking advantage of that greater income in their portfolios. So we do get the question around, hey, should I be concerned? I'm not getting the same level of yield above treasuries I would have gotten historically. We think it makes sense that that's where we are in the markets, and investors shouldn't have fear about that.
What about high yield specifically, where I have often said, this has equity-like volatility at times. And so I think it's fine to pursue that higher income, but you do have to be prepared for those bouts of volatility and a potential meaningful drawdown. Do you agree with that? And what are your conversations like with clients around allocating to high yield?
Yeah, we agree with that, generally speaking, that, it's definitely, if you've got very high quality fixed income on one end of the spectrum, equities on the other, high yield's certainly somewhere in between. And even more so maybe than higher quality credit securities, when you look at high yield spreads, just the additional income you're going to get above treasuries, you're getting about 2.66% if you're just looking at the index level. So especially when you're taking on the greater credit risk that comes with high yield, you have to be aware of, is the compensation worth it? So there is that more cautious view of the sector. If you take the other side, though, similar to what I was talking about with higher quality bonds, if you look at the high yield market, the lowest quality securities, CCC rated debt, is a very small component of that benchmark universe, of the high yield universe overall, than it has been in past decades. The market quality has been upgraded overall, as a lot of the lower quality issuance has actually taken place in the form of private credit or the loan space. So we think it's a higher quality market. And let's not miss the fact that the starting yield in that part of the market is about 7.2% today. And so while it certainly is more volatile and there's more credit risk than higher quality bonds, you're getting a pretty attractive return outlook. And it is a more defensive asset class when you compare it to equities. If we go back to 2020, the last real sustained credit event, high yield was down, 12, 13%. That quarter for March of 2020, but then you compare it to equities, which were down, 20 to 30%, depending on the index. So you're getting a pretty attractive return with definitely a more defensive allocation than equities. So we still think for the investors who are looking for that higher income, they want to sort of maximize the income in their bond portfolios. We don't think they need to shy away from that part of the market. Just be aware of the fact that, you're not getting quite as much compensation above treasuries than you have in the past.
By the way, I'd be remiss if I didn't mention that Vanguard recently launched the U.S. High Yield Corporate Bond Index ETF, BCHY. I just think about how far that category has come over the past couple of decades. Okay, so we've talked credit risk, duration risk. One area we haven't yet covered when I think about the fixed income category is international bonds. And of course, Vanguard offers a total international bond ETF, ticker BNDX. That's taken in close to $10 billion this year. So I guess two questions. What do you think has been driving interest here? And then more
Yeah.
broadly, how do you paint the case for international bonds?
Yeah, if we look at just the international bond space, that's another sort of standout. We talk about ultra short bonds taking an outsized share of flows. Global bonds would also fall into that bucket. And I think a big part of this has to be the fact that, for several years, we saw across the globe in many of the major economies and markets, policy was really moving in a similar direction. You saw many of the central banks sort of making moves that caused the interest rate curves across these different markets to move a little bit more in tandem. Now what you're seeing, especially with the conflict that's been going on this year, different markets are affected very differently by what's happening. Central banks are responding in different ways. And that's been a very dynamic experience so far this year. And so I think that investors are kind of taking note of the fact that, hey, there's a lot happening in these different markets. They're all at different points in the monetary policy cycle, the economic cycle. And so maybe some diversification really does make sense here. And that just comes back to what we think is the everlasting, standing case for international bonds. It's a world of opportunity when it comes to international bonds. When we look at different markets, each one has pretty different characteristics. In one market, you may have big dominance of treasury or government-focused bonds, where in other markets, you may see a bigger presence of securitized products. Different countries issue at different points of the curve, some with longer-term bonds, some with shorter-term. The credit quality ranges. And so our research has shown over time that investors, in most cases, are pretty well, they see a lot of benefit from a diversification standpoint of just taking a bit more of a global approach to fixed income. If I'll just give you one stat that we look at that we think is pretty compelling. If you just look at the U.S. Ag Index and compare it to the Global Ag ex-U.S. and dollar hedged for U.S. investors, you kind of compare the performance of those two indexes over time. The Global Ag ex-U.S. hedged actually outperforms about 52% of the time. So we went back 35 years. We're looking at annual clips there. So it actually outperforms slightly more than the U.S. Ag, and it does so with almost a full percentage point lower volatility. And so when you think about the power of adding an allocation to bonds outside the U.S. in your portfolio, you're getting the same or better returns with a lower volatility profile. And in our experience, that's what people want in their fixed income portfolio. They want that stability. That's why they're allocating to the asset class. So for us, it's a trade that we think really shows a lot of value over time for investors.
I think I know the answer to this, but despite the fact that I think you're right, investors clearly want that diversification. I talked about the flows into something like BNDX. I'm curious, as you talk to clients, do you tend to see the same home bias in fixed income that we see in equities, right? Where U.S. investors, they prefer to invest in their home country. Is that every bit the same issue with bonds as well, or not quite as bad?
Honestly, anecdotally, it feels like maybe it's even worse in the fixed income space, meaning, folks really see mostly they want to just have that U.S. allocation and haven't spent as much time thinking about the benefits of an international bond allocation. So I'd say the bias is there and potentially even worse. Vanguard has historically put an international bond allocation into our target date funds. We have it in model portfolios that we provide for advisors. So we're putting it through in the way we construct portfolios. And I think the flows are showing that maybe interest is picking up, but certainly agree with you that the home bias is there in my experience.
One other quick question as we talk international bonds, and I don't want to get too far into the weeds here, so we can just stay higher level, but BNDX, it hedges its currency exposure. So is there anything in particular you would point out regarding that? Like, I'm just thinking as investors and advisors, consider there are various options here. Why hedge versus not hedge?
Yeah, when we look at in our research over time, we've seen that if you add that unhedged currency risk, basically if you introduce currency risk into your portfolio, it tends to introduce an incredible amount of volatility. And so the way we look at it, especially as we think about the use case for bonds, providing a stability to a more volatile equity component of a portfolio, we found that you actually get, in many cases, better returns and certainly much lower volatility by hedging your currency risk. We think that's true for U.S. investors and really for any investor who is investing in bonds outside of their local currency. We found that it generally makes sense to hedge that exposure back to your local currency. And the benefit is, especially when you're working with a large fund or ETF provider, the hedging cost is really minimal, just a couple of basis points, and has certainly compressed over time. So you're able to get that hedged return at a low cost in a very effective way. And we definitely think that that's the right way to approach an international bond allocation.
But it sounds like it really comes down to that volatility profile. That's the key there.
Yes, definitely.
I know we're running a little short on time. I want to ask you about a couple of ETF-specific topics, which we touched on some fixed income ETFs here. But I want to start with a broader topic, which is this continued rise of active ETFs. And Vanguard does offer a number of active bond ETFs. So, for example, the Vanguard Core Bond ETF, ticker VCRB, or VGHY, the Vanguard High Yield Active ETF. And I know many people, you know the story here, they always associate Vanguard with passive investing, but you're actually one of the largest active managers by assets. And so very simply, I'll ask you, how do you like to frame the active versus passive decision to investors? Like, say they're looking at BND versus VCRB. How do you frame what that decision-making should look like?
Yeah, well, we've found that for a lot of investors who are making the active versus passive decision, one of the first questions they ask is, how much is it going to cost me? And oftentimes may opt for a lower cost investment. We're really fortunate at Vanguard that if you compare our active versus passive bond ETFs, we're able to offer both at a price that is really low. And so we want to make that less of the decision point for clients. We want them to have low cost no matter where they're investing, active or passive. So let's just take that out of the equation, although that is for other, at other shops, that may be more of a consideration point. We tend to see that for the clients who they really prioritize transparency. They want to they're okay with just getting the risk and the return that the market provides. We tend to see that a passive or an indexed fund can be a great solution for them just to get that market exposure. And a big component with advisors is if you're taking on the decision to partner with an active manager, you're also taking on a degree of overseeing that manager, trying to understand their process, how they approach the market, and then making sure over time that they're actually delivering on the excess returns they're seeking. And that is a burden. It's a cost to especially advisors who are making that decision. So for the investors and advisors that prefer to just get the market return, they don't want to necessarily aim for anything higher, and they like the transparency and simplicity, index can be a great option. But we know in fixed income, and including if you compare it to equities, we still see that a lot of investors and especially advisors see that there is opportunity for excess returns in active. The complexity of the fixed income market, benchmarks have improved over time, but they're still not covering the full breadth of the market. There's always new instruments being introduced. It's a very dynamic market. And you also have the presence of non-economic buyers in fixed income who are basically going to buy fixed income and be less valuation sensitive. All of these things create opportunity for an active manager to actually outperform in the market. So we've seen investors prefer that over time at a higher degree than in equities. And for investors who want to shoot for more, really maximize their return and feel like they have a talented manager to partner with, we definitely point them in the direction of active. And we have pretty high conviction in our own team that we can deliver consistent, risk-controlled, strong returns over time, or we aim to do that, I should say.
Yeah, and your last point is actually a really good one. It's something I talk about all the time. You mentioned the complexity of the fixed income markets, whether real or perceived. I think when investors and advisors look at the equity market, they have a higher level of confidence in themselves that they can navigate it. Again, whether that's accurate, we can debate. Yeah. But I think when they look at the fixed income market, they do see much more complexity. And so I think they're more comfortable bringing an active manager to the table to help them navigate that complexity. So I think you were sort of saying that. I think either way, I think we're going to continue to see flows in launches. We're going to continue to see that category proliferate. One other area I'll ask you about real quick is target maturity ETFs, because earlier this year, Vanguard launched an entire suite of target maturity corporate bond ETFs, which, obviously these allow investors to ladder their exposure if they are concerned about some of the things we've been talking about, rising rates, or maybe they just want to match assets with liabilities, right? And you look at these ETFs, only 8 basis points in terms of the fee. Just talk a little bit about the opportunity that Vanguard sees within the target maturity ETF category.
Yeah, it's a perfect tag on to our whole conversation here, Nate, because we've been talking about just the 2022 experience, what that maybe still means in the minds of investors and advisors. What we've seen since that time is a lot of interest in the target maturity ETF category. We've also seen just the growth of separate accounts where clients have the transparency into their portfolios. They feel that there's more predictability and cash flows. All of these product types have really taken off, especially since 2022, and is no doubt probably a response to the volatility and the volatility that was experienced that year. So we're excited to have this offer in market for our clients to have what we would say is more precision, more control, kind of the sort of predictability that you get with an individual bond, but you're going to do it with the liquidity, the diversification, and the low cost of an ETF. In one of these ETFs, you can get exposure to 500 different bonds, and you're going to get that with the expectation that you're going to see those bonds mature in a year and get your principal back as you would with an individual bond, but you're doing so with much more diversification. Over time, we've seen that the challenge can be with managing whether it's a separate account or individual bonds. The obvious challenge is you don't have that diversification and your returns overall may suffer because you're not able to get exposure to a broader basket of securities. And so this ETF the series of ETFs is really an answer to that. And we've seen a lot of interest from our clients and advisors thinking about transitioning maybe some laddered portfolios or adding this to their process to lower their costs, to make their practice management a bit easier, but still meet that demand from their clients to have more predictability, to have more control in their bond allocation.
Well, Rebecca, with that, we are going to have to leave it there. What a fantastic tour through the world of fixed income. Really enjoyed this conversation. Excellent perspective. Thank you very much for joining me.
Thanks so much, Nate. I really loved chatting with you. It's a great conversation.
That was Rebecca Venter, Senior Fixed Income Client Portfolio Manager at Vanguard.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Jon Maier, Chief ETF Strategist at JP Morgan Asset Management, who, of course, is a top 10 ETF issuer, actually now number 6 on the leaderboard. They've continued to move up that list. Currently, 78 ETFs in all, about $340 billion in assets. And just this year, they've taken in close to $50 billion in new money, led by the JP Morgan NASDAQ Equity Premium Income ETF, JEPQ, along with the JP Morgan Ultra Short Income ETF, ticker JPST. But Jon leads the firm's ETF Insights, which is a global program that provides actionable thought leadership and resources for the ever-evolving ETF universe. That includes the quarterly guide to ETFs, certainly one of my favorite ETF resources and something I'll be discussing with Jon, who is now joining me from New York. Jon, always great to connect. Welcome back to the podcast.
Thanks, Nate, for having me. Always great to be here.
All right, so a lot we are going to get into, including your recently published midyear outlook on ETFs. I thought there were some excellent takeaways on both the markets and ETFs and that. But let's start with this JP Morgan guide to ETFs. And for people who haven't seen this, I'll tell you, I love this guide. It's filled with absolutely beautiful industry charts and tables and data. I think there's something like 60 or 70 ETF charts in this. There's also some ETF education, which I obviously love that as well. But to start, just tell everyone about the work you're doing on this. And I'm curious what all goes into publishing this each quarter.
It's a global effort, and it takes a huge team to come out with the guide to ETFs, both in the US as well as EMEA, APAC. We just released the Australia version today. So it takes a lot of effort. And from our perspective at JP Morgan is like we want to be the go-to place for education. Many of you have heard of the Guide to Markets led by Dr. David Kelly. We also had the Guide to Alts, the Guide to Retirement. Now we have the Guide to ETFs, which is our fourth educational module. It's been out for roughly 2 years at this point. And the idea behind the guide was to provide education about active portions of the market, passive portions of the market, how ETFs trade, fixed income, equity, different trends like model portfolios or thematic investing. And what we do is it's updated with new slides on a quarterly basis, but the actual data in the US is updated on a monthly basis. So we have the landscape of the market, and it's been a real hit from our perspective. And folks like you, as well as just the end investor, if they want to find out about ETFs and what's going on with ETFs, how to trade them, how to look at them, here you go.
Yeah, and to be clear, this is a free resource. Anybody can access this. Do you want to tell everyone where the best place to go to download this is?
Yeah, there's various places you can do it. You can go to our website. You could type in Guide to ETFs, JP Morgan, you'll find it there. So Google's becoming kind of the old way of finding it. You can find it on ChatGPT or Claude or some other AI agent near you. So yeah, lots of ways to access it at this point. Also, we have an app, an Insights app.
So it is everywhere. Okay, so I mentioned that there are, I don't know, 60 or 70 charts in the guide. Do you have a favorite chart or two in this, like one that you always look forward to seeing the updated data or visual each quarter?
Yeah, there's 58 slides, and it's funny when we create some presentations, and you only can use 5 or 6 slides. It's hard to kind of to whittle down the slides. You love all your children, so but if I had to pick two, one would be guide slide number 10, and if you take a look on the web, you can find that. And the title of the slide is ETF exchange volume during periods of volatility. And just to quickly unpack what this slide does, and I'm not sure if you have it in front of you or not, but we looked at the ETF universe, ETF exchange volume relative to the overall market volume over the past 15 and 20 years. And what we have found that ETFs represent about a quarter of the volume of the overall market and on any given day. And then when you have spikes in volatility, whether it be energy crisis, COVID, or the Iran war, just to name a few, you'll see that ETF volume spikes. And that's because ETFs have the ability to absorb liquidity in the marketplace. So ETFs are really an integral part to the overall market. And I don't think a lot of people realize that. Without ETFs, there could be a lot more volatility in the market because they're like shock absorbers. So that would be guide slide number 10. Another one would be guide slide number 11, which is 11 is my favorite number. And this slide is investors are turning to ETFs, and they're turning towards actively managed ETFs. So what this slide does, if you take a look at it, is looks at cumulative flows of both mutual funds as well as ETFs. And you'll see that there's cumulative negative flows for mutual funds, very much in a big way. And active ETFs as well as overall ETFs goes the exact opposite. So investors are moving towards the ETF structure because I'm sure you talk about it all the time, the tax efficiency, which is, I think, is the superpower, liquidity, access, and fees. Fees tend to be a lot less.
All right, so you like tracking the trading volume for ETFs and then this continued rise of active ETFs. Those are the two that jump out at you every quarter.
Yeah, because it really kind of indicates that the importance of ETFs in the marketplace and kind of the shift in the marketplace towards the ETF structure.
Let me ask you this: if we, you can tie this into the guide to ETFs if you'd like, but if we just take a step back and we look at the broader ETF industry right now, what do you see as 2 or 3 of the biggest trends at the moment? And my guess is the rise of active ETFs, which you already touched on, would probably be one. But like what would be your top 2?
Well, the proof point for active ETFs is we've had about a $1.2 trillion of flows this year. And in terms of AUM, active AUM is about 12% of the overall AUM, 88% is passive, but 37% of all the flows this year have been into actively managed ETFs. So that's one proof point. The second is that there's a lot of white space from my perspective in the fixed income area of the ETF marketplace, both active and passive. But the growth of active fixed income has really been a standout. And it's a trend that we're seeing both in the US as well as outside the US. So right now, there's only 16% of the $16 trillion in ETF assets is fixed income. So there's a lot of room to run. And we're projecting by 2030 that the global fixed income ETF marketplace will grow to about $7 trillion. So that would be another trend. And kind of a shiny object trend is the comeback of thematic ETFs. We've certainly seen a resurgence in thematic ETFs. But from my perspective, working both at JP Morgan as my predecessor firm, thematic ETFs really should be used judiciously inside an overall portfolio, used in a measured way, because they potentially can add a lot of volatility to your portfolio. So if that's going to be your only exposure, you may want to look at kind of where that fits into your overall asset allocation.
No, I think those are excellent trends that you pointed out on thematics. I know particularly this year, we've seen a lot of interest around artificial intelligence related themes. And it's interesting because thematics a few years back, they had this huge rise and then there was a lull, and now we've seen them come back very clearly. I also agree with you on the fixed income ETF side, particularly in the actively managed fixed income category. I do think there's still a lot of white space there. I always talk about how I think particularly for financial advisors, they're very comfortable navigating the equity side of the equation, but not quite as comfortable on the fixed income side for whatever reason. And so I think they're more apt to look for potential solutions there. And I think we're going to continue to see proliferation around actively managed fixed income ETFs. Well, again, I would highly encourage everybody to check out the guide to ETFs every quarter. It's free, seriously, an excellent resource, and a very easy way to stay on top of everything occurring in the industry. Okay, Jon. So in addition to that guide to ETFs, JP Morgan recently published its US ETF midyear outlook, which you helped author. Do you do that twice a year? Like, do you do sort of an annual outlook and then this midyear outlook as well?
Yeah, and those are the type of pieces that actually gain a lot of traction in terms of readership. I think both financial advisors, our distribution team, as well as the end user, doesn't necessarily want to see what's going on a day-to-day basis. Us as kind of ETF guys like to see it every day, but I don't think everybody does. So like those mid-year pieces definitely gain a lot of traction. So for sure, you see a lot of interest.
Yeah, and so I enjoy this. And in this mid-year outlook, this came out a few weeks ago. You highlighted three themes that you believe are impacting how investors and advisors are allocating assets right now, and how that ultimately impacts ETFs, right? So everything from ETF flows, which you touched on earlier, trading volume, which you also touched on. I would say new launches. You were tying in these market themes to the ETF world. And the three themes that you mentioned in this particular outlook were volatility, concentration, and diversification. And I'd actually like to go through each of these briefly, if you don't mind, and have you offer some color. And the first one, volatility. So you said volatility is the regime, not the exception. And you said that a lot of the volatility that we're seeing falls into two buckets. You noted this tug of war around AI, whether all of the spending by the hyperscalers will ultimately produce results, and then geopolitics, obviously with the Iran conflict. And so, talk more about how both of those are impacting ETFs.
Well, volatility is something that we're very aware of. We're always aware of it as investors, and the overall volatility numbers, if you look at the VIX, is relatively low. But if you really kind of dig down and look at the individual components, there's some very volatile stocks out there, and there's less volatile stocks, and they kind of cancel each other out. So you have to kind of be aware of that when you're building your asset allocation. Now, investors right now, from my perspective, and where you're seeing some of the flows go into ETFs is the derivative income space. And you mentioned it earlier, JEPI and JEPQ. Derivative income is one of the largest and fastest growing areas of the ETF marketplace, from my perspective. And investors are using them to generate attractive levels of income, while at the same time reducing portfolio volatility. So a fund like JEPI, for example, it's managed to a lower volatility in the underlying portfolio. And then you have an option overlay on the portfolio that also brings down volatility. So that a fund like JEPI falls into your equity allocation and reduces your overall volatility in your equity bucket, your equity portion of your portfolio. So I think that's one of the reasons investors are moving towards that portion of the market. And for us, the derivative income space is certainly important. We're garnering about 50% of that overall market, which is pretty significant. Doesn't mean there's not competitors coming into the space, but we feel like with our active managers, looking at the underlying holdings in a portfolio, building a portfolio, and then having the option overlay on top of that is really resonating with investors. And also, with the AI tug of war and geopolitics, so it's really important to kind of manage that volatility. And we are seeing those flows vet out in this derivative income space. And we're also seeing an additional growth into active ETFs just in general, because if you're having a manager doing bottoms-up research, having hundreds of research analysts analyzing companies, and having just a tremendous amount of technology built on top of that, your outcome is likely going to be that much better.
Yeah, and it was interesting because you pointed out that obviously active ETFs, these are being used as both core holdings, but also like satellite or risk management sleeves for some investors, just with these themes around volatility. So I thought that was was an interesting point. The next theme that you mentioned is concentration, which this is one that obviously investors have been talking about for a while now. But as you know, the concerns haven't gone away. And so, what are you seeing here regarding the potential ETF impact?
So, first of all, we know that the broad-based indexes have been dominated over the past several years by uh, the top 10 names, or the Mag 7. And the hyperscalers have certainly been front and center. And that's kind of been like the first stop on the AI story. There's been a tremendous amount of CapEx. And I think the market at this point is trying to digest whether there's an ROI there. So there's ROI concerns in the market. And the first part of the year, the hyperscalers actually were not the biggest contributors, or actually not the contributors to the returns of the broad-based indexes. You really saw a widening out, a dispersion into the other portions of the market. And some of that is AI related, because kind of the secondary beneficiaries of the AI trade, whether it be infrastructure or energy or semiconductors. And the semiconductor portion of the market is certainly can be volatile. And then there's sub-slices of the semiconductor portion of the market, like the memory market, moved up very fast. We saw that in some individual ETFs, pulled back 40%, coming back over the past few days. To that point, an active manager can identify those companies that can really benefit from this CapEx spend, and who is the secondary and the tertiary beneficiaries of the AI trade. So that's what an active manager really can do. And I think as we're seeing broadening out in breadth of the marketplace, uh, whether it be broad-based, just growth exposure, even value, or slices of the technology portion of the market, I think that an active manager leveraging different tools that particularly we have here at JP Morgan is going to benefit investors over the long haul.
Well, and to that point, something you mentioned that I thought we should emphasize here is that you have some investors and advisors who they may look at this AI theme and they look at the top-heavy S&P 500 index and go, "I'm just going to abandon the AI theme altogether. There's too much concentration there." What you said is no, that's not what you're suggesting. It's more just balancing that out and rethinking how you access the AI theme. That it is much broader than just these hyperscalers, the mega caps out there. And I thought that was, again, a very important point for people to understand. Um, by the way, when you were discussing this theme, you also made a very interesting point around how index rebalances and methodologies have created, let's say, some peculiar situations. So, for example, we've seen value ETFs that own SpaceX and those sorts of things. And I think your point was this is yet another reason why active management can be valuable. Do you want to talk more about that?
Well, sure. We know that the AI, it's crucial to be diversified within AI and tech just in general, because the narratives really are changing so fast and so rapidly. So I feel that the allocation needs to be constructed across single stocks, subsectors, and different sectors that fully access the beneficiaries of AI. And that could be both value as well as growth. We know energy is a big component of the AI trade. So utilities can be a beneficiary. We can see certain companies that were historically, value companies that have gone up 5-6x this year. That's because of the energy trade or the industrial component of the AI portion of the market. So it does touch the AI does touch every single part of the market. It's pretty wild. Things are moving so fast. And passive funds are more concentrated than ever. And investor can use active sleeves for these different types of exposures, both value, international, to overall improve their diversification.
All right. So we covered concentration. We covered this other theme around volatility. The third theme that you pointed out is diversification. And you talk about how diversification is finally back when you look at performance across various investment styles and asset classes, geographies. And from an ETF impact perspective, I'll tell you, Jon, that I've actually talked a lot about how if you think about ETF flows, this is very, very relevant because there's obviously an ETF for everything now. And so, regardless of what's working or what isn't, the industry is going to vacuum up money, right? Whereas in the past, I always felt like flows were much more market dependent. I would say, especially US stock market dependent. And that's no longer the case. And so, I don't think that's exactly what you're hitting on with the diversification thing. We can get into that. But do you agree with that just regarding ETF flows?
I think flows tell a few different things. So you can look at sector flows and on a daily basis, weekly or monthly basis, and it'll give you a sense of investor sentiment depending on what time period you're looking at. So that's kind of like the quick money. Then if you look at it over a longer period of time, where most investors actually invest for the long haul, they don't necessarily invest purely just for 1, 2, or 3 days like you see in some of these single stock levered ETFs. So I think ETF flows in particular areas can give you kind of market sentiment, but also by setting an investment objective over a longer period of time is really important. And some of the active strategies, whether it mean growth or value or international, and particularly international value right now, can be like kind of good placeholders to build a cohesive portfolio for 1, 3, and 5 years across, depending on your investment horizon.
All right. So besides flows, what other ETF takeaways are there regarding this diversification theme?
You're hearing a lot about shiny objects in the marketplace. From my perspective, I just brought it up a second ago, single stock levered ETFs. I think there's some misunderstanding in the marketplace about what certain ETFs do. Like single stock levered ETFs, for example, really the average holding period is probably 4 days. So that's kind of fast money moving in and out. That's not the bulk of the market. So if single stock levered or say $50 billion, you add the index based or kind of broader based in levered ETFs in that category, it's about $200 billion. You contrast that with the overall market, which is $16 trillion. It's just a slice of the market. The large portions of the market where money is flowing into tends to be growth in value and in international derivative income, more sustained areas where investors are looking to build these cohesive portfolios.
But Jon, it's so much more fun to cover the shiny objects, especially on here.
It is. I get caught up in it. I write about it here and there, but that's not really how singles and doubles is how we all retire, from my perspective.
No, it's a great point though, because when you look at flows, clearly overall investors are being pretty smart overall in terms of how they're allocating to the market. You can see that in the types of ETFs that appear on the ETF leaderboard, for example. It's just that these shiny objects, they suck all the oxygen out of the room just in terms of media attention and discussion because they are interesting. We know the core portfolio building blocks, they're doing their job, they're working. So I think people look to these high flyers for an interesting story. Just a few minutes left here before I let you go. How is everything going with the JP Morgan ETF business? I mentioned the nearly 50 billion in inflows this year. I know JEPQ, JPST, and some others, JEPI, they've had excellent years in terms of investor interest. What's the quick state of the union for JP Morgan ETFs?
It's been a very strong year. We've seen a strong year in some of our core ETFs like JEPI and JEPQ and JPST. Our active fixed income suite has brought in a tremendous amount of assets. Just one more note on active fixed income. For the most part, if you think about like the ag really only covers about 50% of the addressable fixed income market. There's so many other portions of the market that are not covered, that an active manager can find those opportunities. And if we can tell that story correctly to investors, we're going to make them more money and their fees are going to be lower. So active fixed income is certainly an area of the marketplace that's both us as well as many of our competitors are talking about. We have about $255 billion in actively managed ETFs, about $306 billion globally. Our overall ETF business is about $400 billion globally. We do have some passive in there as well. And our growth rates are very strong. And in terms of our product pipeline, we're looking at the marketplace. We're looking at trends in the marketplace. We're looking at what portions of the market that our investors cannot access with JP Morgan funds, and can our expertise be leveraged, whether it be preferred funds or high yield funds to build fixed income portions of our portfolio. So we're moving on with the market. We're a leader in active for sure. We're the number one in active. Sometimes we toggle between AUM 1 and 2, but our flows are number one. So very strong market.
Well, it's great to hear, and congratulations on all the success. I always enjoy our conversations, Jon. Thank you for joining me.
Thanks, Nate. I really appreciate it.
That was Jon Maier, Chief ETF Strategist at JP Morgan Asset Management. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Tarek Saab, CEO and co-founder of Texas Precious Metals, who's behind Y'all Street Asset Management, which recently launched physically backed gold and silver ETFs that hold 100% of their metal on American soil. And so we're going to discuss why they think that's important, and we'll obviously talk about the investment case for gold and silver as well. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.